Good evening, everyone. I hope my voice and video is very clear to you. May I get a quick confirmation over the YouTube chat box? Am I audible and visible to you? Am I audible and visible? That's great. Awesome, awesome. So, welcome you all to the grand revision of financial reporting and strategic business reporting combined in one video. I've been getting a lot of queries that, ma'am, are we going to have this session this quarter? Of course, whatever happens in personal life is different, but we are going to continue with what we are doing professionally. And we are going to have a 3 hour session, okay, where I'm going to discuss with you almost every IFRS that is important for your attempt. Like whether it is your FR paper or SBR paper. So you all know that in FR, what we studied is being asked as it is in SBR with some additions. So I'm going to cover first the FR aspect and then I'm going to cover the SBR extra aspect. So people who are giving FR, this particular session is equally relevant to you. One, once I will start with SBR component, I'll inform you that now it's like bye-bye to you. So you can leave the session from the FR perspective and I'll continue from the SBR perspective, right? So let's get started. And to keep the momentum of the session, I want all of you to be enthusiastic in the chat box, put a thumbs up on the video, and just share this link with as many friends of yours as possible because this is going to help everyone pass the paper. We are at a stage of our preparation where a lot of information is there in the head, but it still feels like we don't nothing. We still feel like, when we are doing questions, from where to get the information, from where to get the knowledge, the standard knowledge. And then we go back to the notes, we go back to the lectures, and we figure out, okay, this was asked and that was asked. And we are cluttered with information. So this is that one session when we are going to compose and consolidate almost the most important knowledge that we have gathered so far in our studies for the last 3 months. And of course, this will be a little bit fast because this is a grand revision. So this is not, disclaimer, this is not for people who are studying from the scratch. It is going to be very fast, quick, and it will touch on the important areas, not in depth, but just from the, outer crux so that you remember, okay, in this topic, this was the thing that I should remember or I must have remembered. So this is not for the students who think that, okay, I'll just watch this video and I'll pass SBR. This is for the students who studied and now they feel that, okay, I'm cluttered with information. We are just left with few days before the exam. So you can take this as a very important, okay, this is a very important resource for you to pass your paper. So let's get started, guys. And we already have approximately 150 people here, right? And I'm going to share my screen with you. So let's start with our rules of the sessions first so that there's no confusion at all. Okay, fine. So this is the IFRS Grand Revision, which is being used by FR students and SBR students. Okay, now let's see. The first rule of the session is that you are going to keep up with the pace. Now, what do you mean by keeping up with the pace? I don't want anyone to say that, can you explain this again? Why? Not because I am adamant and I don't want to explain you, but because I'm doing a YouTube live and there's a luxury that whatever I've said, you can just scroll a little back and you can rewatch that part even when the live session is going on. So, wow. So we have to keep up with the pace, right? And secondly, if you feel like I'm going too fast, okay, you can maybe watch the recording of this session, which will be available on YouTube itself. So don't ask me in the chat box, ma'am, will the recording be available? Yes, yes, it will be. Of course, I know we are here from various time backgrounds. So of course, nobody can make sure that they're attending it live at all times. So of course, recording is available on the YouTube channel under the live section column of my channel. And we are already 40K strong. I mean, come on, today I hit 40K subscribers on YouTube. Thanks to all of you. And thirdly, we are going to give you the notes. Okay, so whatever I type on the Word file today, I'll give you as note, something that I don't type. If you feel that is important, maybe an example, maybe some story around the concept, you can jot it down on your piece of paper. So keep something in front of you on the desk where you can jot things down. Now, sometimes I'm going to refer to question names. Now, especially for the okay, so especially for the, I would say SBR students, you guys are my favorite. So not reality, okay, but because FR students are equally my favorite, but I'm going to refer to question names because the students are going to have questions from SBR more than FR, because of course the technicality level and the difficulty level of two papers is very different. So I'm going to refer to case study names and I'm going to say, oh, this one you must have seen in Margi, this one you must have seen in Mehran. But if you don't remember the name of the questions, I will write the name on the note. So if I mention a question, it is going to be from Kaplan Kit. For SBR, of course, it will be from the Kaplan Kit. After the class, you can refer to that question or you can have an overview of the question. If you would have practiced it before, you'll be like, oh wow, I remember it. But don't have that FOMO that, oh my God, ma'am is referring to a question or a case study that I've not done. And then you just have a nervous breakdown that maybe I'm not good enough. No, my purpose of mentioning the case study name would be that, okay, after the class, if you want related to this concept, you can refer back to the question yourself. Okay, I hope that makes sense to all of you. So this is going to be our rules for the session. And now let's get started with our first concept, which is going to be our non-current assets. Now, non-current assets, what do I mean by these non-current assets? Now, in FR and SBR and F3 also, you have studied about it. Non-current asset is any asset that is kept for more than 1 year, right? So any asset that we keep for more than 1 year with us is a non-current asset. That automatically means that any asset that we keep for 1 year or less is a current asset. Now, this asset can be, number one, this can be a tangible asset. Now, what is a tangible asset? Anything that I can touch, see, transfer from one place to another, from, I can wait, I can hold it. So that is a tangible asset. So one of the segment is tangible asset. Second segment is intangible asset. Now, this is something that I cannot see, touch, or transfer. So that is basically coming from, for example, the goodwill, the brand value, the intellectual property. Then you have stuff like your driving license, a right, a contract, an agreement. All of that is basically your intangible asset, correct? So we have two segments. Now, under tangible segments, what kind of assets can one have? One can be something like I have some kind of a property. I have a land. I have machinery which I use in the factory. I have my office. I have my furniture, or I have a shop or a commercial place, fans, lightings, machines, equipments. So all of that comes under IS 16, that is property, plant, and equipment. Second tangible asset could be something that I don't use in business, but it exists. For example, investment property, right? So that is something which is existent. That means I have a property, but I'm not using it for my business. Maybe it's idle, or maybe I've given it on rent. So that is investment property, right? So these are the two segments under tangible asset, IS 16 and IS 14. Then we have intangible asset. We have just one standard on it, that is IS 38. Okay. Now these are the standards that we have studied in F3 also. But the most important thing which still remains constant for them is their definition. Okay. You can be asked questions on its application of the definition as well, right? And you could be asked something about, like, for example, uh, you know, you can be asked on its accounting treatment as well. So let us insert a table and let's understand that what all things we might have. Okay. Yeah. So first we are going to talk about the definition of all of these. Definition. Then we are going to talk about its initial accounting treatment. Then we are going to talk about the subsequent accounting treatment. For which standards? I'm going to refer to IS 16. Then I'm going to refer to IS 40. And then I'm going to refer to IS 38. So these are the things under my radar. Now, definition of IS 16 property, plant and equipment. So that is basically anything that I use in the process of my business. So something that is used in manufacturing, okay, something that is used in manufacturing, something that is used for administration, or something that is given on rent and or self-occupied. So if you are an entrepreneur, if you are a businessman, your office is your property, plant and equipment. But if you are staying in a house, even that is your property, plant and equipment. Because if you will not have the luxury to stay or have a good stay place, then how would you be able to work, right? So that is my property, plant and equipment. If it is registered under the name of the business, of course. Then investment property. What is that? It is a property which is just kept for, maybe keeping it idle. So maybe we have just bought it for the purpose of capital appreciation. So it is kept for capital appreciation. That means it is basically idle, or we rent it out to other people. So we give it on rent to third parties. So now you can be given a situation, you guys are very smart, you know what is group accounts, right? So there can be a situation where there's a parent and there is a subsidiary. So let us take that situation. Okay. So there can be a situation where there is a parent and a subsidiary. Now let's suppose the parent has given its property on rent to the subsidiary. Now, in individual accounts, parent and subsidiary are individual or independent entities. But in consolidated accounts, they are both one parties. So now, in individual accounts, if a property is given on rent to a third party, then it is investment property. But in consolidated accounts, because they are one, that will be regarded as IS 16 because subsidiary is using it for its business. So in consolidated accounts, both of them are one. So subsidiary's business is parent's business, right? So that is something which is important for us to know, right? And this is like an application part of the concept. Then what is IS 38? IS 38 is intangible asset. So for example, let's talk about the identification criteria of intangible asset. They have no physical substance, first of all. So physical substance is basically, you can touch, see, or transfer it, but they don't have any physical substance and they are identifiable. Okay, so they're non-monetary assets. That means they're not readily convertible into cash. That's also a very important aspect of their characteristic. And then they are going to lead to probable economic probable inflow of economic benefit, right? So that's very important for us to know. And then they are also identifiable. What do you mean by identifiable? Identifiable means that they can either be sold separately. So I can sell that asset separately, or it is arising out of a legal or a contractual right. So this is what I mean by a intangible asset. Now, when I say that it's legal or a contractual right, see, if you have a driving license, your license can't be sold to anyone else, right? It's yours. You can't say that my brother will drive the car on my behalf. So that is like, it can't be sold separately. But it is arising out of a legal contract. So what is the legal or a contractual contract here? You've got it registered from the government and you've got a right from the government that yes, you can drive the car in this particular country without any obstructions, right? So that's how it becomes an intangible asset. Now, what is the initial accounting treatment for all of them? It's kind of same. First is that I'm going to take the purchase price Then in the purchase price, I'm going to add the directly attributable cost. Okay. In that, I'm going to add the present value of future dismantling cost. Okay. So I'm going to add the present value of future dismantling cost. I'm going to add the borrowing cost here as per IS 23. If there is any irrecoverable tax, that's also going to get added here. So irrecoverable taxes are basically, for example, you are not registered for VAT or GST in India, but you paid GST, okay? So if I was registered for GST, for example, in TG professionals, we are registered for GST. And if I buy an equipment, let's suppose I buy an iPad for my teaching. So I would pay the GST on it, right? But I can claim it back. So I will charge GST from my students, and I'm paying GST for the purchase of the iPad. So that will get set off, right? So it becomes recoverable. So whatever GST I paid on the purchase of the iPad, I'm recovering it from the GST that I've charged from the students. But in case you're not registered for GST or VAT, that becomes irrecoverable tax. So in that case, you add it into the cost of the asset. So this is same here, copy paste here and copy paste here, right? Then subsequent accounting treatment for IS 16. We basically here have two models, okay? There are two models. Number one is cost model. So in cost model, I keep my asset at cost as the name suggests, and I will deduct the accumulated depreciation from it and any impairment that might be charged on that. That will be deducted. So I keep it at the basically carrying amount. I keep my asset at carrying amount. Then I have revaluation model. So what happens in revaluation model? So basically, you take your asset to its fair value whenever you think that it is necessary to take it. So I take my asset to its fair value, but I don't do it at each year end. Rather, what do? I will take it to its fair value whenever necessary, whenever I feel that the difference between the carrying amount and the fair value is significant. Okay. And I'm going to take the revaluation gain from other comprehensive income and revaluation loss via statement of profit and loss. So this is the rule, okay? Revaluation surplus goes via OCI, but if there's a revaluation loss, that goes via P&L, right? So this is revaluation model, and we do depreciate a revalued asset. So depreciate the revalued asset. In fact, you recalculate the depreciation amount. You take the revalued amount divided by the remaining life of the asset, and that becomes your new, you can say that becomes your new depreciation. Then comes IS 40. See, the cost model here also is same. So I'll just copy paste this part. Okay. But here we have a different model apart from revaluation model, which is fair value model. So let's understand the concept of fair value model. Whenever the name of the model changes, the rules of the model will also change. So don't think that revaluation and fair value model are two interchangeable terms, because they are not. So in the fair value model, what I have, I'm going to take my asset or investment property to its fair value at each reporting date. Okay. And I will not depreciate the property. Okay. Because I'm already taking it to its fair value at each reporting date. So if there will be a depreciation or a fair value downward, it will be reflected at each year end. I need not do it again and again. Then I will take the fair value gain or loss via the P&L. I'm not going to take it via OCI at all. It will go via P&L only. So these are the rules of fair value model. In revaluation model, there is one more characteristic, because here you do it whenever it is necessary, right? So it's not necessary that every asset will require revaluation. But they say there is a concept of no cherry picking. There is a concept of no cherry picking. That means I will not just revalue one class of assets. Okay, I am going to revalue the whole class of assets. So I can't just say if I have five uh, equipments, I just want to revalue one of them because I feel I'm making a gain on it. No, I will have to revalue the whole class of that equipment. So if I have 10 computers, if I'm revaluing one computer, I'll have to revalue the 10 of them. So that's the concept, right? Now, these are the basic differences between revaluation model and fair value model, which is very important, which can be asked directly also, which can be asked in an application form also, okay? And from FR perspective, you can see a section B question where they can ask you that what is the difference between revaluation and fair value model? And of course, they can give you the four options that in revaluation model, there is no depreciation. In fair value model, there is a depreciation. So that would, of course, be incorrect. So you're going to questions only if you know the basics, right? Are we clear? I want to see whether we are having the high energy or not. Come on in the chat box. Are we clear? And just drop or just keep on putting some reactions or some kind of thumbs up so that I know everyone is there with me on track. Okay. The next one is IS 38. IS 38 subsequent accounting treatment is exactly same as your IS 16. Okay, so we'll just copy paste this. So we are just going to say same as IS 16. But the only difference, guys, is that in IS 38, instead of depreciation, we have something known as amortization, right? So let's not forget that. We are going to have amortization here. And there are two types of intangible assets. One is definite life intangible asset. Second is indefinite life intangible asset. So definite life is something, as the name suggests, that you know the life of that intangible asset. And it's very, from the SBR perspective, if I talk about the judgment here, it's very ambiguous. It's very gray area, or it's very judgmental area to know that what is the life of an intangible asset. How? Let's think about it. Let's think about it. You tell me, how is it ambiguous? How is it a gray area? See, for example, you have Corbel company question in SBR, Corbel, Corbel company. So there they've talked about life of various brands, right, which are intangible asset. Now a brand which is under IS 38 is already something which is very difficult to account for. Because how do you know the brand value, right? Until and unless you go in the market and you try to sell that brand, you would not know the brand value. How would we know the brand value? Sitting here, can I tell you the brand value of TG Professionals? No. But if tomorrow I intend to sell this company, I would get to know that how much the counterparty is ready to pay me extra. So if the net worth of TG Professionals is X amount, if someone is paying me 2X or someone is paying me X plus something, so that plus amount I can say is the goodwill or maybe is because of the brand. So I need to ask them, why are you paying me extra? Right? So brand, it is already very difficult to account for. Now to come to know about the life of the brand, for example, TG Professionals, okay? TG is me. So what do you think? What would be the brand, if there's a brand value, what would be the life of that brand? Because it is associated with me. I'm a mortal being. I'm not immortal, right? I'm going to die someday. And of course, let's not talk about that. But I'm going to maybe stop teaching someday. Okay, maybe there's going to be someone else there who's going to teach better than me. So there will be some kind of like you have celebrities and the brands associated with their name, so someday they'll be less famous. So that's when we know that this brand has a definite life. That's why if you go to Shark Tank or if you go to somewhere else, they would ask you that, are you scalable, are you independent, your brand is associated with you, or is it separate? So you have to estimate the life of the brand, which has a lot of troubles in that. And in the Corbel company question, that was examined. That why determining the life of a brand is a difficult task. So there we gave a general answer that because it is associated with various factors, it talks about the demand, it talks about the market value, it talks about if it is associated with a factor or is it associated with a big name in the industry or a celebrity or a person or a product. We need to see what is the life of that person, life of that product, or fame span of that celebrity. So that way we were examined in Corbel company. So that way we have to determine whether it is definite or indefinite. Now, if there is a brand with an indefinite value, for example, McDonald's, we don't know what will be the life of the brand. Can you determine it? Can we determine that? Of course not. We all love McDonald's, right? But we never know, someday someone is going to surpass McDonald's and just, in a moment of 4 5 years, maybe, once the substitute comes, we might replace it in our head. This way, many businesses have gone down, many businesses have vanished from the market. This happens, right? But still, we don't know. How can we determine it? So we say it is indefinite. So for the definite life assets, intangible assets, I have to do amortization because I know the life of the asset. So I'll take the value of the intangible asset divided by the life of the asset. For indefinite life asset, I will conduct annual impairment review as per IS 36. Because I don't have a life, but that does not mean that the brand value is not impacted or amortized. So I will conduct an impairment review. I'll compare the carrying amount with the recoverable amount. Okay. And I'll get to know if there's any impairment or not. Right? Makes sense? So this is what we have for brands under intangible asset. Then there are certain internally generated brands also. There are some companies who are so overconfident that they will tell you we have a brand value. And they sat on the table and one day finally they decided we have a brand value. But we don't trust these people. Because of course, let's suppose you go and buy a company and that company says, I have this asset, that asset, I have goodwill in the market, I have brand value. Of course, they will say this because they want to pitch you a higher price. They want to get higher price out of their business. They would do this, right? That's a natural instinct. But we don't trust the brand value that they tell us. We trust the brand value which a expert tells us or which is coming from the market. So what we say is that internally generated brands are not recorded in the financial statements. But when we consolidate, okay, if there is a brand value which the counterparty says that it exists, and we are paying a price for it, we are paying a price to buy that company, and that party says we have this brand value. So after the purchase has happened and we are doing the consolidation, that is when we are going to record an internally generated brand in the consolidated accounts. So internally generated brands are not recorded in individual company accounts, but they are recorded in consolidated accounts. So let's just jot this information down in our short notes. Yes, let's just jot this down. So we've learned about definite life intangible assets, which are amortized, and indefinite life are held for annual impairment review. And the question related to it for SBR is Corbel company. And then for internally generated brands, let's just jot this important point. Okay. Internally generated brands are not recorded in individual accounts, but are recorded in consolidated accounts. That's why in consolidated accounts, we have a topic of danger items, right? So in that danger item, one of that is internally generated brand. What about internally generated goodwill? See, internally generated goodwill is neither recorded in individual accounts nor in consolidated accounts. Because in consolidated accounts, we calculate the goodwill on acquisition, right? So we don't need the estimate of the management of the counterparty. That's what we have as a rule from IS 38. Lastly, from IS 38, there is a concept of research and development, which is widely tested across FR and SBR. So from research and development, you should know that the research expense or cost is expensed. So research cost is expensed. Development cost is capitalized. Now, how do we differentiate between the two? We need to see if the Pirate criteria was met or not. What do you mean by Pirate criteria? We have studied it since F3, where P stands for probable economic benefit. So if you think there will be a probable economic benefit, that is our, okay, yes, it is an asset for us. Then do you have an intention to complete the development, or are you just faking it, right? Then do you have the resources to do so? Do you have the resources to do so? Then do you have the ability? Do you have the ability to use or sell whatever you are developing? Either you'll use it in your own business or you'll sell it, right? So do you have that ability? Then only it is something which is beneficial, right? Then do you have the technical feasibility? Do you have the technical feasibility? Lastly, can you make its reliable estimate? Okay, then only you will say it is a development cost which is capitalized. Otherwise, you will say that it is a simple research cost, right? Very simple, very easy. This is what we have for our three standards, IS 16, 40, and 38. We have covered them in as much detail as we could because they are very important standards from the perspective of FR and SBR both, right? Now let's move on to another set of standard which is important from NCA topic. Let's talk about IS 36. So I've been saying annual impairment review, right? So what do you mean by impairment? Impairment is basically reduction in value of the asset. How do I know that there is an impairment? When there will be an indicator. Now this indicator can be internal indicator or it can be external indicator. Now internal indicator of an asset is, for example, a key personnel has left. So let's suppose someone knew how to operate the, how to operate a very specific industry or a factory equipment, but that person has left. So key personnel has left. Now that is an internal indicator of impairment of that particular equipment. External indicator can be some natural calamity, for example, right? Or it can be something like a lockdown that has happened due to which our instruments are now idle. So these are indicators of impairment. Now, if there is an indicator of impairment, I am supposed to conduct an impairment review. What do you mean by impairment review? I have to take lower of, I have to basically take lower of carrying amount and recoverable amount. Now, how do you know what is the carrying amount? It's given to you in the question in the trial balance. How do you know what is the recoverable amount? Recoverable amount is higher of cost, higher of net realizable value and value in use. What is net realizable value? Basically, if I sell the asset, that is fair value less cost to sell. So whatever is going to be a better use for me, either selling it, that is fair value less cost to sell, or to keep on using it, that is value in use. So how do you calculate the value in use? You have rules for that. I have to calculate the present value of the cash flow, net cash flow, okay, present value of the net cash flow. If the asset is used till its life. So whatever is the life of the asset, if I keep on using it till then, what will be the money that I'll generate out of the asset and what is the present value of that? That is basically value in use. So how much money you will generate, you will have to assume a growth rate, right? You are basically budgeting that how much money I'll make out of this asset. So if you assume a growth rate, either it has to be zero, or it should be declining, okay, or it should be constant. So you can't say that for the first 5 years, the growth rate is 5%. For the next 5 years, it's 10%. You can't keep it on the increasing trend. You have to either keep it zero, or you have to keep it under the decreasing trend, or you have to keep it constant, right? So value in use, we calculate, we take higher of NRV and value in use as recoverable amount. Then we take the comparison of carrying amount and recoverable amount. If the carrying amount is greater than the recoverable amount, then only impairment will arise. Then only impairment arises. And first, the impairment loss is taken via related revaluation surplus if it exists. If it exists, then via P&L. So basically, you first take out the loss from any related surplus that might have existed, just like we do for evaluation downwards. And if there is no surplus related to that particular asset, then we take it via P&L, right? So this is the rule for impairment. Now, for certain standards, there is an annual impairment review that is conducted. So which are the standards for which we conduct annual impairment review? First, I conducted for goodwill. Second, I conducted for intangible assets, which are indefinite, which have indefinite life. Correct? So this is what I have for my IS 36 impairment. Then there is a concept of cash generating unit, okay, which is very important. Cash generating unit, which basically is a small group of assets which generate cash flows independently. So what is a CGU? It is a small group of assets which generate cash flows independently. So basically, for example, you have, a hotel, and within the hotel, there's a spa, there is a, restaurant, or there's a bar. So these are different areas within a restaurant. So every area is conducting its own revenue, or it's generating its own revenue. Maybe it also has a golf course. So, they are making their own money. So a group of assets which generate the revenue together, that is a CGU. Now I might have to impair a CGU. For that, I will list its carrying amount of the assets. I'll only consider non-current assets here because current assets are never impaired. So I'll take the carrying amount, I'll compare it with the recoverable amount. And how will I allocate the impairment to a CGU? That's a very famous question for FR and SBR both. First, I'll allocate it to the goodwill. Okay, first I allocated to the damaged asset. So if in the case study they have mentioned that there is a specific damaged asset, so I first allocate the impairment to that asset. Then I allocate it to the goodwill, and then I allocate the remaining impairment to rest of the non-current assets on pro rata basis. On pro rata basis. So I'm going to do it on pro rata basis. So what is pro rata basis? That's basically where we weighed that, okay, this is the weight of this particular asset under the total, carrying amount, and this is the amount of impairment that should be allocated. For example, let's just take a quick example. So let's suppose there's a CGU which has a property, plant and equipment, which has an intangible asset, which has a, let's suppose, goodwill, okay, and the value of the carrying amount is, here it is 100, here it is 150, here it is 50. So the total carrying amount comes out to be 300, right? And let's suppose the recoverable amount of this total CGU is given to you as 200. So the total impairment is 100 and there is no damaged asset as such. So first allocation of impairment will be to the goodwill. So out of 100, 50 will be allocated to goodwill. So I'll have zero amount for goodwill. Now the remaining 50 has to be allocated to these two assets on pro rata basis. So how will I calculate the weight of PP? I will say total of these two is 250. So the weight of PP is 100 out of 250 and I have to allocate the remaining $50 impairment. Similarly here the weight of intangible asset is 150 out of 250 and I have to allocate 50. So this is how I will allocate the impairment to the remaining assets on the pro rata basis. Yes, are we clear on that? And that is it for IS 36 impairment. Lastly, what I have from NCA topic that I want to discuss with you is IFRS 5, which is widely tested in both the FR and SBR modules. So let us look at it. Let's look at IFRS 5. So IFRS 5 is basically a standard for non-current assets held for sale and discontinued operations. Discontinued operations. So let us understand what are non-current assets held for sale. So non-current asset, now you all know, it can be an intangible asset, it can be a property, plant and equipment, or it can be an investment property. Now, it is held for sale only if the following criteria is met. And that criteria is caption. Now, this is just a mnemonic that I've given to you. How do you complete caption? Caption is basically, first of all, there should be a commitment to sell. Secondly, there should be an active plan to sell. So in the case study, you have to see whether all these conditions exist or not. Then you should be selling that particular asset in the present condition only. That means no repair, no maintenance. Then sale should be probable. So as per your analysis, there should be a proper probability that yes, sale is going to happen. Then it is going to happen within 1 year. Then there will be no change to the plan. Now, if all these conditions are met, guys, that's only when we say that it is held for sale, right? And caption once is met. Okay. Now, what is going to be the accounting treatment if caption is met? The accounting treatment is that I will now classify my asset as current asset because it is now going to be sold within 1 year. So it is classified as a current asset. Secondly, I'm going to stop the depreciation of that asset because I'm going to sell it in the present condition. So that means I'm not using it anymore. So there should be no depreciation of it. And thirdly, I'm going to keep it at its lower of carrying amount and fair value less cost to sell. Why? Why fair value less cost to sell and not value in use? Because I am going to sell it within 1 year. So value in use does not matter to me now. There's no point of calculating that what will the value be if I keep on using the asset. Because I'm very clear that within 1 year, I'm going to sell the asset. Right? Now that's what I mean by non-current asset held for sale. And that's the accounting treatment. Now, what is a discontinued operation? If the above criteria is met, and what do you mean by a discontinued operation? That's basically when you are planning to shut down a particular segment of your business or a particular branch of your business, which is basically a separate major line of business that you're planning to shut down or planning to shut off. Basically, it's a major line of business either due to its nature or because of its geography. So maybe it's different because of the products that you're selling, the services that you're giving, or it is different because of the geography. So maybe it's a branch in UK, US, UAE, right? So you have to see what we are talking about. So separate major line of business either due to its nature or geography. That's what we mean by a discontinued operation. Now, once there's a discontinued operation and it meets the caption criteria, the accounting treatment is same. Okay, every asset will be classified like this and will be the accounting treatment will be same. But there will be one extra. Okay, there will be one extra treatment, that is, I am going to give a separate line of disclosure in statement of profit and loss where I will show profit after tax from discontinued operation. So if you have guys seen the new standard IFRS 18, if you have gone through that video of mine, IFRS 18, you would know that yes, the format of P&L has changed where we have various changes and we have a proper, heading where we say profit from operations and then we say profit from discontinued operations. So we have a separate line item here where we show profit after tax from discontinued operations. That's it. So this is the accounting treatment for discontinued operation. It's a very short and cute standard IFRS 5, but very important. I would say it's very important from the perspective of AAA also. So if there's anyone giving AAA here, this one is equally important for you. So here we have covered like almost 1, 2, 3, 4, 5 very important IFRSs from the perspective of FR and SBR and partially for AAA as well. So just give me a thumbs up if you are clear on it, and we'll just move on to the next one after a 5-minute break. Okay, so just put a thumbs up or a heart or a yes in the chat box. That would work for me to know that yes, we are here with the flow of the session. Yes, so let's meet after 5 to 7 minutes and let's continue. Okay, let's continue with IFRS 15 after the break. So let's take a break of 5 to 7 minutes and we are going to continue with IFRS 15. Okay. Yes, guys, am I audible to you again? Hello, hello, mic check. Am I audible? Let's continue with IFRS 15. Okay, let's talk about IFRS 15 revenue. Now, generally, guys, we all know that what revenue is, like the money that we generate by selling the product or the service that we deal into. But we used to have a separate standard on revenue before IFRS 15. Okay, but then what was the need of IFRS 15? Because we did not have any particular ways through which we could deal with complex contracts. So IFRS 15 talks about revenue from contracts. And now there's a five-step approach to revenue. Okay. Number one is that we have to identify the contract, of course. And then we have to know whether a contract exists or not. There should be rights and obligations on both the sides. There should be a commercial substance to the contract. There should be payment terms. There should be a probability that you will be paid. So it's not for charity, it is done for business purely, and we are going to make money out of it. That's what commercial substance and the definition of contract is. Then second step is that after identification of the contract, second step is that what are the various performance obligations within a contract. Now, it is not necessary, that if, let's suppose you're taking SBR classes from me, it's not necessary that I'll only teach you the concepts. What are my performance obligations? To teach you SBR, to teach you the case studies of SBR, to take your test, take your mocks. We had a mock few days before, and today also the second mock was given out for SBR. So that's basically like, okay, we have various performance obligations within one setup. Now, we have to identify those performance obligations for various complex contracts. Now, once I have identified the obligations, I have a transaction price, I have a contract price. Now, how do I allocate that? What price is related to which performance obligation? So I have to basically allocate the transaction price to separate performance obligations one by one. So, for example, I would determine that, okay, if I was only taking mocks, what would I charge? If I was only teaching concepts, what would I charge? If I was only helping you with practice, what would I charge? So if I'm selling something independently, what I'm trying to say here is within a contract, if I'm selling various performance obligations separately, I would know what is their independent uh, transaction price. And accordingly, I can allocate the transaction price, right? So first I have to see that, okay, what is my, whether there's a contract or not, then I have to see separate performance obligations, then I have to determine the transaction price, then I have to allocate the transaction price. These are the four steps. And the fifth step is to record the revenue. Now, the revenue can be recorded at a point in time or over the period of time. So if today I go and buy maybe a fruit from a grocery shop, and I will just go pay money and get the fruit. So that is basically at a point in time. I'm just selling, I'm just going to the market, buying something and paying the money, and I get the control of the fruit. The moment I pay for it, I can eat that fruit, right? So I have the control of it. But there are certain things, for example, if I'm giving you access to live classes, if I'm giving you access to live course of SPR, I teach you that over the period of time. It's not that you paid for the course fee on that day. I will say, oh, okay, I made money. Let's just move on. No, I am obliged to teach you throughout the course and the live classes if it exists. I am supposed to transfer the control of the live classes to you over the period of time. For the recording, somehow I can say that yes, the control has been transferred if that gets downloaded into your system. For example, if I give you pen drive classes, so as soon as the pen drive is delivered to you, in that case you would say that the control has passed, and that's when I can record the revenue. But if you are watching the lectures on my portal, the control will pass over the period of time. So I'm taking this as a classic example, but in the real life, in the industry, there are more complex examples and situations that we have to deal with. So IFRS 15 gives you guideline when the revenue is recorded over the period of time. We have three conditions to it, which we will jot down and make it in our notes. So let's just type those three conditions out. So what we have in revenue is, let's see what basically we have in revenue. Okay. Let's see. Yeah. So we are starting with IFRS 15 revenue. The most basic aspect of it. We have 5 steps to it. First is identify the contract. I'm not going to explain that. I've verbally told you. Then we have the identify the separate performance obligations within the contract. Okay. And then we have the transaction price. So determine the transaction price. While determining the transaction price, always keep in mind that, for example, if we have a situation of significant financing component, that means we are going to receive the money a little late, so we are going to consider the present value of it, okay? And we are going to unwind the interest. Whenever we are going to calculate present value, we are going to unwind the interest, okay? And then we have the other aspect of variable consideration. So it's not necessary that the transaction price is simply given to you in the contract. Sometimes it is dependent on various factors, that if this is fulfilled, this is extra that you will get. If this gets completed by this timeline, this is the money you'll get. So we have to determine the most probable amount that we will receive. Okay, the most probable or the best estimate of the amount that we are going to receive. Then we also have non-cash consideration. So what happens in non-cash consideration? That's basically barter system. So for example, if I teach you and I ask for video editing services from you, so that can be a barter system that, for 1 quarter, I'm going to teach you SBR, and for the same quarter, you're going to help me edit the lectures. So that would be a non-cash consideration that I'm receiving. Now, in that case, how do I record it? First, I will see, as a service provider, I'm going to see what is the fair value of good or service that I have received, service received. That is going to be my transaction price if that is unavailable. If above is unavailable, then the fair value of good or service provided is taken into account. The fair value of good or service provided is taken into account. Okay. So this is what I have for non-cash consideration. Then you also have cash paid to customer. This is also a very strange situation, cash paid to payable to customer. So I give you an example in the class, if you remember. Can you tell me the example in the class that I've given you for my students of SBR? Come on, let's see who remembers it. Cash payable to customer. So there was a crash course that we conducted in Delhi, and the people who were traveling from outskirts of Delhi, they said, it's very expensive for us to have a face-to-face crash course. We didn't have the online facility back then. So we said, okay, we will give you some compensation for your traveling expense. So people, the customers, the institute with which I was working, they charged the students, okay, they charged the students something, and they also gave them a compensation to travel to the place of crash course. So basically, they took money from the student and they also paid money to the student. So that was cash payable to customer. So if you are paying cash to the customer and the customer is also a businessman, so in that case, it will be a separate account. So it's like, you have separate relationships. So for example, you run a grocery store and you have a restaurant in front of your grocery store. So you eat your lunch there and the restaurant buys grocery from you. So it's like you both are each other's customers. So sometimes you have to pay them, sometimes they have to pay you. So that can be a situation. And the other aspect could be when you, like the Delhi crash course example, in that case, it is treated as a discount. So if the institute was charging, let's suppose, $100 for the crash course and $20 was given as a compensation for travel, then in net, I would say these transaction prices $80. So that's how you basically determine, okay, that's how you basically determine that what is the transaction price. Then the fourth step is to allocate the transaction price to separate performance obligation. And you do that on the basis of standalone selling prices. Okay, so that's done on the basis of standalone selling prices. If that is unavailable, then we'll have to do it on the weighted average method or the best estimate method. Then we have the recognition of revenue. That's the most important step where we either record it at a point in time or over the period of time. So we record it at a point in time whenever it is not over the period of time. So question is, when is revenue recorded over the period of time? So when do you record it? OTP. Only when any one of the following condition is met. So what is the condition? Number one, customer simultaneously receives and consumes the benefit. So that's basically customer is simultaneously receiving and consuming the benefit. That's example is teaching. When I teach you, whatever I say or utter, you are simultaneously receiving it and consuming it. So I can't say whatever knowledge I've given you, give it back to me, right? So in that case, the revenue is recorded over the period of time. Second is, for example, if you are doing construction, so when you are enhancing or creating an asset controlled by the customer. So if you are enhancing or creating an asset controlled by the customer or owned by the customer. So there is a customer's piece of land and on that I'm doing the construction of a building. I can't be the Bob the builder and pick up that building and run. Right? So whatever work I have completed, I deserve to be paid as per the completion of work. So that is where we have and we should have an enforceable right to payment, right? An enforceable right to legal right to payment. Third is that what if the asset is controlled by us only? For example, we have a piece of land and we are constructing something over it, but whatever we are constructing is customized. It has no alternate use to me. So if you are enhancing or creating an asset controlled by the entity but has no alternate use to the entity. For example, in case of customizations, right? If you're getting some gift customized with the face of your friend, okay? So you're getting, let's suppose, a watch with a face of somebody. So now only you have the utility of that watch, nobody else. So the entity can't sell it to someone else, right? So customization is something that we have to take into account. And these are the three things and if any one of these is met, the revenue is recorded OTP. Otherwise, it is recorded at a point in time. Then within revenue, we have one last concept that I want to discuss with you. That is sale and repurchase. Again, from the perspective of FR and SBR, both very important concept. We sell something and then we have an option to buy it back. Now, this is kind of, you know, this is kind of same as right to return, isn't it? Because generally when we have a right to return, let's suppose I sell something with a right to return. That comes under variable consideration, that what is the probability that how much of the goods will come back to us. And then according to that, I have to basically decide what is my revenue to be recorded, right? This kind of collides, or I would say it is kind of same as the right to return concept. But what is sale and repurchase? It is that I sell something, but I have an obligation to take it back. So within that, there are few options. Number one is when I sell something, I have an obligation to take it back in the future. So that is a forward. Okay. Then second aspect is that I sell something and the person who's buying it, the buyer, has an option to give it back to me. That's a put option. Now, when the buyer puts it in front of me and say, take your product back, it's bad. There are 2 points to it. Do I have an obligation to take it back? So is it a put option with obligation or is it a put option without obligation? I have to determine that. So basically put option lies with the buyer, where the buyer puts the asset back in front of me and says, take your goddamn product back. I don't want it. Do I have an obligation to take it back or do I not have an obligation to take it back? Then third is call option, where I can call for the product back. I am the seller, where seller has an option to call the product back. So in these cases, okay, if it is a forward contract that in future you'll have to take it back or you'll have to buy it back, this is not a sale. Input option where you have an obligation to take it back, it is not a sale. But in put option without obligation, it is a sale. Okay. There's a call option. It is where the seller has an option to take the product back. This is not a sale. Now that's what the rule says as per IFRS 15. But of course, I don't know if you remember it from your Super 20 of SBR. You should remember it. I think it was Jacinta company question. Jacinta or Benito, one of them, where we did a question where, I think the question had this word Sear company, where you were selling some equipment to Sear and Jacinta. Okay, this was Jacinta, where Jacinta was selling an equipment to Sear at as per the rules, it was not a sale because it was put option with obligation. So as per the rules, it was not a sale. But actually, once we read the case study and we applied our judgment, because this is not AI, right? That we have put a rule and we have to take out the conclusion as per that only strictly. Here we apply principles. Here we go by the spirit, not the letter. Okay, there are two things. One is rule, one is the spirit of the rule. So we go by the spirit. So as per the case study, there was a situation that it was probable that the buyer is not going to give the equipment back to you. So that is why we said it was a sale. So this is a very important aspect. Jacinta company for SBR people, you must refer to it for the sale and repurchase concept. And for the above five, you should refer to ZTech company from SBR perspective. That will help you revise the five steps of revenue recognition, right? So now if it is not a sale, what it is? See, IFRS 15 says if the repurchase price is greater than the original selling price. If the repurchase price is greater than the original selling price, then it is basically a loan because you're paying the premium. But if the repurchase price is lesser than original selling price, then it is a lease, right? This is what we have as a concept from IFRS 15. Again, just confirm and just throw a thumbs up in the chat box if we are okay with IFRS 15. We had a good revision of IFRS 15 so that we can move forward to IFRS 16 now. Yes, I will provide you the PDF of whatever I'm writing on the chat and the on the Word file right now. Are we clear on this? Come on, guys. Yes or no? Can I get a confirmation? We have two questions. By far, you have Jacinta, ZTech, and I told you one more question, Corbill, that you should try. Okay. Awesome. Wow. So we are all here in the session, right? Not sleepy. Have a cup of coffee if you want. Don't go and make it for yourself. I hope you have someone to call for coffee. Okay. Clarified. Great, 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 great. IFRS 16 leases. Let's talk about that. IFRS 16 leases. Okay. Now, what is important from leases is to know that what is the lessee accounting. And you all know what is lessee, what is lessor, right? So lessee is someone who takes the apartment on rent, and lessor is that weird looking landlord who gives the apartment on rent. Okay. I'm not doing the complete, as I said in the beginning, this is not a complete touch on the topics. It's like we are just revising the crux, okay? So contract modification is not that important from IFRS 15, so we are skipping on to it. And what is important was sale and repurchase that I have done in depth. Let's come to IFRS 16 leases. So this is lessee and lessor. Lessee is someone who takes the apartment on rent, and the lessor is someone who gives the apartment on rent. And we are given lessee accounting and lessor accounting. So lessee initially records an ROU, right of use asset, and a lease liability. So lease liability is basically the present value of payments. Okay, present value of lease payments. Now, when we have to calculate present value here, we take the interest rate which is generally implicit in the lease contract. Something which is given in the lease contract already, we take that interest rate, or we take, if this is not given, we take the incremental borrowing rate. If the leased asset was purchased instead of leasing. So if instead of leasing it, I would have bought it, and to buy that, I would have taken a loan, what would be the interest rate? That's what is used as a rate for the calculation of present value of lease payments. Now, subsequently, what happens? Subsequently, what you are supposed to do? For ROU, you are supposed to depreciate it, okay? You have to see what is the shorter of life of the leased asset, or the lease term. And for lease liability, since you have calculated, okay, since you have calculated the present value, you will have to unwind the interest as well. So you do unwinding of the interest. That's your subsequent accounting treatment. Okay. And for the lessor is very simple. We have two types of leases for lessor perspective. One is operating lease, which is a general lease that you have taken an apartment on rent for 6 months, 1 year, 12, maybe 1.5 year. Generally, it's 1 year. That's an operating lease. But what is a finance lease? That's basically you've taken something on rent for a very long term, not just a very long term. Maybe you've taken it on, or you've paid something, your lease liability is equivalent to almost the fair value of the asset. So that is also a finance lease. So there are various aspects as per which we decide if it is a finance lease or an operating lease. For operating lease, the lessor will record the rental income whenever accrued. And for the finance lease, we are going to record what? For the finance lease, that's basically your price that you pay, okay? And it's like you're giving something on rent for a long term. And in that case, you de-recognize the asset. And you record a receivable. It's basically like you've sold it only. Okay, so it's not no more there with you. So this is what we have for finance lease lessor accounting. Now, what is more important from IFRS 16 is sale and leaseback concept, which confuses a lot of students. So let's talk about sale and leaseback concept. There are two aspects to it, which is when it is a sale and when it is not a sale. So there are two aspects: when it is a sale and when it is not a sale. It is not a sale. So this is sale and lease back. What do you do from the lessee perspective? And what do you do from the lesser perspective? See, what happens in sale and lease back is that someone sells their asset and takes it back on rent. So the person who sells becomes the lessee, and the person who buys, they become the lessor. Now, whether it is a sale or not, for that, I have to refer to IFRS 15. Where do I know that whether it is a sale or not? There are various indicators of transfer of control. So control transfers, for example, when you have title being transferred, or when you have the control being passed, the risk and rewards being transferred, whether the item has been given to the counterparty and they've accepted the item or the product. So there are various aspects where we have the indicator of control being transferred. Now, if it is a sale as per IFRS 15, what do you do? See, if it is a sale, the seller de-recognizes the asset, first of all, de-recognize the asset. Secondly, it records a receivable because you have sold something, so you'll receive money. Then you have to do lessee accounting. For that, you calculate your ROU. How do you calculate your ROU? Present value of future lease payment divided by fair value of the asset into the carrying amount of the asset. So PV over FV into CA. That's the amount of asset that you have retained as ROU. Then you have lease liability, which is present value of future lease payments. And then the balancing figure comes out to be your profit or loss on disposal. Now, there are two aspects. Sometimes the sale can be above fair value of the asset. Then the extra proceed that you receive because you have sold it above fair value, that is your financial liability. And when the sale is below fair value, then the less amount that you have received is your prepayment. Now, for the practice of this particular aspect, this is the most important aspect. When it is a sale from the perspective of the lessee, for SBR students, for FR students, they don't ask you in so much detail. For SBR students, you can refer to Mosaic company question, which is an TYU in your Kaplan text. This is not a kit question. This is a text question, Mosaic company, where they have taken above the fair value concept and they have applied this whole concept. So you can practice that. You'll understand it better. Okay. In the Super 20 questions also, we have done a part of it. Then we have the aspect when it is not a sale. Now you have received money from somewhere, but it is not a sale of your asset. So first of all, you will not de-recognize the asset. I will not de-recognize the asset. Now, if I will not de-recognize it, what will I do? I have received money from somewhere that will be treated as a financial liability. So that's like I've taken loan from someone. So it will be bank debit, loan credit. But actually, legally it is a sale, but economical substance is saying it is not a sale. So legally I'll be paying rent, right? Because I've taken it back on rent. So whatever rent is paid, that will be treated as interest on loan. So that is going to be the accounting treatment if it is not a sale as per IFRS 15. What will the lessor do if it is a sale? Lessor is basically the buyer. So he will record the PPE, whatever he has purchased, and he will record a payable, and he will record or do his normal lesser accounting based on whether it is operating lease or a finance lease. Then if it is not a sale, what will the lessor do or the buyer do? So legally it is a sale, but economically it is not. So he has actually, not purchased the asset. So he will not record the PP, but he will treat it as a loan given, which is basically a financial asset, right? So this is what you will take this as a, and there will be no lesser accounting, of course, and there will be a loan given. So the entry would be financial asset debit, bank credit. Simple. And to practice this concept, okay, if you feel that, okay, I need some practice question on it, there's a wonderful question right after Jacinta That is Benito company from SBR. Right, so Benito company, which gives you a proper detail of sale and lease back, and it also relates sale and lease back with sale and repurchase. That's it. So this is what we have from IFRS 16, sale and lease back. Again, a very important, interesting concept. Are we all clear? Yes. Can I get a quick thumbs up if we are clear on this? So I'm going to move forward with IFRS 9. Okay. So IFRS 9, that is financial instruments. Again, very important standard from SBR and FR perspective both. And I think one of your favorite standards. What do you say about it? Do you like IFRS 9? Do we love IFRS 9? What's our experience with IFRS 9 so far? Very complex. Okay. So we like IFRS 9, right? That's what I hope. Okay. So let's move forward to IFRS 9 now. Then we'll take a short break and move to group accounts. Okay. Now I'll be a little slow. Okay. IFRS 9, the favorite standard. Yes. Okay. So let's just have a glass of water. Maybe you must have received your coffee so far. I don't know. But keep a water glass in front, if not coffee, at least water. Let's take deep breath and move on with IFRS 9. Financial instruments. Okay. Okay. Now, what are these financial instruments? Why are they there in our life? Let's not question that. But what are these financial instruments? Basically, if you buy shares of a company, if you issue your shares of the company, or if you buy debt instruments, these days, the reason financial instruments are there in our life is because people are very smart. They are now not investing into properties. They are no more into just, uh, talking about stock, gold. Now they are very smart. Companies are getting listed. There is something known as shares, bonds, debentures. We are in the stock market. Everybody is there in the stock market. So the accountant will have to bear the burden of it. So here we are, financial instruments. Literally everyone holds a financial instrument. I am damn sure every person who's sitting here, we have 170 peeps. I'm sure each one of you must be holding some stock or the other, or someone in your family must be having it. So you know what a financial instrument is. Maybe you don't have a listed company who issues shares, but you do buy shares, right? So financial instruments, there are two types of financial instruments. One is financial assets. Then we have, okay, then we have financial liability. And of course, there is equity. So equity is basically when we issue our own shares. Okay. Now, financial assets further are of two types, where I basically, I do an investment by buying shares. So that is termed as equity instrument. Or let's first talk about debt instrument, where basically I buy bonds or debentures of a company. So when you give loan to someone or you buy debentures slash bonds, that is debt instrument. For financial, second type of financial asset, what I have is equity instrument. Second type that I have is equity instrument. So basically, when I buy shares of a company, when I invest in shares or stocks, right? So that is my equity instrument. Now, for debt instruments, what is the accounting treatment? For all financial instruments, first of all, the initial accounting treatment is very simple, that record the asset or the liability at fair value, capitalize the transaction cost, okay? Capitalize the transaction cost unless the subsequent method followed is fair value through P&L. See, if your subsequent method of financial instruments is fair value through P&L, then of course you will not capitalize the transaction cost, otherwise you will. Now you might have a question in your mind because there's brain fog and because you've done so many things by far, that why capitalization ma'am has written plus minus. Has ma'am gone mad or something? Capitalization is plus only. But why have I written plus and minus? Because in case of liabilities, capitalization of cost means I'm going to deduct the cost from the liability. Okay? Because capitalization is a happy process. So if I add something to the liability, no one in the world will be happy. If I say you are supposed to receive money, you will smile like, a bulb. But if I say you have to pay money, you will not. You will be sad. Right? So in case of liability, capitalization means I'm going to deduct the transaction cost. That's why I said plus minus transaction cost, unless the subsequent method followed is fair value through P&L. We'll get to know what it is. Now for debt instruments, the initial treatment is same, which I've written above. But what is the accounting treatment subsequently? Let's look at it. The subsequent accounting treatment. Let's see subsequent accounting treatment. We have three methods for debt instruments. Number one, amortized cost, which we used to call in our lectures as AMC, amortized cost, where I keep the asset at its amortized cost, basically, which means the table is made for it, where we have opening value of the asset, we add the interest or we accrue the interest on the asset. So that is based on effective rate of interest. From this, we deduct the cash that we've already received on the basis of coupon rate, and then we get our closing asset, right? So this is amortized cost. Okay. Then further what I have is, apart from this, how do I decide that I will take amortized cost as my subsequent accounting treatment? See, for that I need to see or have two tests being conducted. What are these two tests? Number one test is business model test. Or first, let's take contractual cash flow test. Contractual cash flow test is that debt instrument is you've given loan to someone. So you will get the recovery of loan solely in cash. You will get your principal and interest both in cash only and no other form. You will not get any benefit in kind. If that test is met, okay, then I can decide where to keep this debt instrument. If the test is not met, then I'll keep it under fair value through P&L method. So that is the third method, fair value through P&L. So if CCF test is not met, if CCF test is not met, that's when we follow fair value through P&L method. Then second test that I have is business model test. Business model test. So what is your intention basically? You're going to keep this asset till maturity. You're going to sell it whenever you get a good price for it, or you're going to trade with it, right? So what is your intention behind it? Business model test. So if your intention is long term, okay, long term intention plus CCF test met, then I keep it under amortized cost method. Very simple. Then Second method is fair value through OCI. Fair value through OCI. If this is when you are like, I don't know, I might keep it till the end or I might sell it whenever favorable. So this is I don't know situation. Okay. Plus CCF test met. That's when I keep it under fair value through OCI. Third is fair value through P&L. Third is fair value through P&L. I keep it under fair value through P&L only if CCF test is not met or the intention is to trade with that asset. That means to keep it for short term. So I have to decide accordingly which method to choose. Amortized cost, fair value through OCI or fair value through P&L, right? This is the debt instrument basics, which is there in FR and SBR both. Okay, so if you want to try, there is a question which is a T value in your Kaplan text by the name of Tokyo, which will help you see the accounting treatments and the difference between various debt instruments. So you can try this Tokyo company T value from the Kaplan text. Okay. Then comes equity instruments. For equity instruments, there are two methods only. Number one is fair value through OCI, and number two is fair value through P&L. See, generally we buy shares, we trade with it shortly, like within 7 days, 15 days, intraday, or within 1 day only. So the by default method for equity instrument is to keep it under fair value through P&L. So by default method, I need to keep it under fair value through P&L. But fair value through OCI, when do I keep the equity instrument under fair value through OCI? Only if the two conditions are met. What are the two conditions? Condition number one, that equity instrument must not be held for trading. Must not be held for trading. So I should not trade with that equity instrument. Rather, I should keep it in my pocket till the long term. Then only I will keep it under fair value through OCI. So if you are a long-term investor as a company into shares, then yes, you can keep that investment under fair value through OCI. Second is must not be held for trading. Second is you made an irrevocable choice upon designation. So the day you actually bought this asset, you made an irrevocable. What is irrevocable? It's just like an unchangeable or something that you can't alter. You made a choice when this asset was born in the financial statements that this asset will be kept under fair value through OCI. Just like some Indian parents, when the child is born, they're like, my child will become a doctor or my child will become a civil servant. So sometimes, not just in India, I don't know about the outer kind of parenting. I have not experienced it. Okay. So, but point is that some parents are, when the child is born, they're like, okay, my child will become this. Just like that, the accountant, when the equity instrument is born, they say, we make an irrevocable choice that this equity instrument will be kept under fair value through OCI. So if these two conditions are met, then only we keep it under fair value through OCI. Otherwise, we keep it under fair value through P&L. Sorted? Clear? Simple. This one is very simple. Then comes financial liability. For financial liability, we have two accounting treatments. One is amortized cost, which is basically by default method because it's very difficult to get the fair value of a liability. So it's by default method is to keep it under cost model. Second is fair value through P&L method. When do I keep my liability under fair value through P&L method? Yes. When do I keep it under fair value through P&L method? I keep it under fair value through P&L method only when it is held for trading. Now you'll be like, what? Liabilities are held for trading also? Okay. Yes, it does. Sometimes, yes. So liability can also be held for trading where people swap their loans, okay, and they make money around it. Secondly, you want to avoid an accounting mismatch. So to avoid an accounting mismatch. So what happens in accounting mismatch is basically, let me explain you. For example, you bought an investment property on loan. Now the investment property is kept under fair value through P&L, okay? And you say, let's keep the loan under cost. That will be an accounting mismatch because the loan and the property, they were born together in the balance sheet. So they become twins, they become related to each other. So to avoid an accounting mismatch, what we can say is if you are keeping the property under fair value through P&L, let's keep the loan also under fair value through P&L. But this is only for certain accountants, okay? This is for certain accountants who feel this, not for all. This is not like a rule. This is just like if someone wants to avoid an accounting mismatch, they can do this, right? So that's for financial liability. Then we have a concept of convertible debenture or compound instrument. What do you mean by a compound instrument? See, a compound instrument is basically where you issue a convertible debenture. So you issue a convertible debenture. So that basically means the counterparty has a choice to either repay you the principal and interest or to take your shares. Okay, so you issue a convertible debenture. So either you're going to repay the principal and interest or you're going to issue your shares. Now this has aspects of both equity because there's an option to issue your shares and liability. So there are both things existent here. So what do we do initially for this convertible debenture? We do split accounting. How do you do the split accounting? You say, okay, let me calculate the liability aspect of it. So to calculate the liability aspect of it, I would simply just take the present value of future payments that I'm going to make. Okay. So I'm going to make present value of future payments and this is going to be my liability aspect because this is a convertible debenture. So what is my payment of principal and interest? I'm going to take that into account. And for the present value calculation, I will take an interest rate. What is the interest rate here that is going to be taken? It is the interest rate of similar bond without conversion option. Without conversion option. So that is what I'm going to take into account. Okay. So, right. Now, interest rate of similar bond without conversion option, that is going to be my present value factor. Now, what is going to be the equity aspect of it? I've already calculated the liability aspect. What is going to be the equity aspect of it? So equity will be the balancing figure. Whatever you have received, so proceeds minus the above liability amount is going to be the equity. That is basically your balancing figure. Now equity will be kept as it is in your equity section of the balance sheet. How do you treat liability? You'll treat it the same way from now onwards, just like you did for the financial liability above, either amortized cost or fair value through P&L, whichever is applicable. This is what we do for compound instrument. So till here, this is the IFRS 9, which is basic IFRS 9, and the FR students, your IFRS 9 is still here only. So now FR students, if you were sleeping, hello, hello, you can just put your hand on your ears or just drop out of the session until I start with group accounts, okay, which will be after this, so that I can cover the advanced aspect of IFRS 9. So the FR students, our IFRS 9 is still here only. So you can drop out so that SBR students, we can stay back and continue with impairment of financial assets. Are we clear till here? Yes? Are we sorted till here? Come on. All set? So now the SBR aspect of IFRS 9. Finally, something that don't overlap. SBR aspect. of IFRS 9. Impairment of financial assets. So, what do you have as impairment for financial assets? See, financial assets are debt and equity. So, only debt instruments, that too which are kept under amortized cost and fair value through OCI, are held for impairment. The rest are not impaired. That's the rule. Okay, because uh, debt instrument kept under fair value through P&L, they're already taken to their fair value with the loss being reported in the P&L. So there's no need of further impairment of that particular asset. So only debt instruments which is kept under amortized cost and fair value through OCI are held for impairment. Okay, makes sense. Now, there's a concept of credit risk. So if you have given loan to someone, the credit risk signifies the risk of non-repayment. Okay, the risk of non-repayment. Someone who's not going to repay to me, that's a risk, credit risk. Now, when you give loan to someone, you have a risk that this person won't repay. But sometimes that risk increases. Okay, so if the credit risk increases significantly since inception. So how do you know whether it has increased or not? You'll have to apply your judgment from the case study. They would have given you such words that there's a high risk, the risk has become very adverse, the drastic changes are there. So these words will reflect that there is a credit risk that has increased significantly. So if the credit risk has increased significantly, then I need to create lifetime expected loss allowance. So how do I create a loss allowance? I'll talk about that later. But if the credit risk has increased significantly, I'm supposed to create lifetime expected loss allowance. If the credit risk, if the credit risk has not increased significantly since inception, then I will create 12-month expected loss allowance. Now, how do you create loss allowances? See, loss allowances, you have to calculate that what was the contractual amount that you were supposed to receive versus what is the expected amount now. So you will take that loss to its present value. Okay, you will probability weight that what is the probability of this loss happening, and whatever amount you get, that is going to be your loss allowance. And loss allowance is created via statement of profit and loss. Okay, it is not created via OCI. But there's a special effect, and that special effect is when there is a debt instrument kept under fair value through OCI. So what happens for debt instrument which is kept under fair value through OCI? See, IFRS 9 states that any financial instrument cannot be taken to an amount lower than its fair value. So I can't take it to an amount lower than its fair value. That's the rule. So under debt instrument kept under fair value through OCI, already, what is the rule for debt instrument kept under fair value through OCI? The asset is taken to its fair value at each reporting date with gain or loss reported in other comprehensive income, right? That's the rule for debt instrument kept under fair value through OCI. Now, if, for example, there was a debt instrument with a initial value of 1,000. Let's suppose there was a debt instrument with an initial value of 1,000, opening value. Now its fair value at the reporting date has decreased to 800. So there is a loss of 200, right? There's a loss of 200. So as per keeping it under OCI, fair value through OCI, this should have gone via other comprehensive income. Now let's suppose in the question they have said that create a loss allowance of $150. Let's suppose it's mentioned create a loss allowance of $150. Now you will not deduct 150 from here and take it further down from its fair value, because the rule says that any financial instrument cannot be taken to an amount lower than its fair value. So I cannot take it lower than its 800 value. So what option do I have? I can bifurcate this loss only. I can say there's a total fair value movement of 200. So let me bifurcate it. Out of this, 150 is loss allowance and the remaining 50 is the fair value movement. So this loss allowance will go via P&L, okay? And this fair value movement will go via other comprehensive income. So you have to keep this into your mind that we'll have to split the loss here in case of debt instruments kept under fair value through OCI. That okay, 200 loss is there. Out of this 150 is loss allowance and the remaining is the fair value movement. Right? This is one special area of impairment, or you can say loss allowance topic. If you want to re-listen to it, you can just, move a little backwards in the live video and you can re-watch this part. Moving forward, this was about loss allowance, right? We have a concept of credit impairment as well. Credit impairment is basically that now you're sure that there will be no money received. So loss allowance is like provision for doubtful debt and credit impairment is like bad debt, right? So what happens in credit impairment? In credit impairment, that's basically like proven bad debt. So the loss is recorded in P&L. Asset is reduced by the amount of loss and further interest income is calculated at net amount. Whereas in case of loss allowance, the interest income is calculated at gross amount. I've explained this to you multiple times in the classes. Yes, gross amount is before considering the loss allowance. So you keep calculating your interest on the carrying amount of the asset. That is before considering the loss allowance. But in case of credit impairment, first you deduct the loss, whatever is the remaining amount, on that you calculate further interest income. Sometimes we also end up purchase of credit impaired asset. So we might end up buying an asset which is already credit impaired. In that case, we use credit impairment adjusted rate, right? So we use a rate instead of effective rate of interest, we use CIAR for our calculations. Okay, so this we are just touching on the crux of the topics again. There are a lot of details to it, questions to it that we have done, but we are just, we are not going to spend a lot of time here. So we are just going to touch the crux of it so that we remember it. Then the next concept in IFRS 9 from SBR perspective is derivatives. So what are derivatives? Derivatives, they are something which are held for speculation, first of all. You don't want to take delivery of derivatives, okay? You hold them for speculation only. They are very short-term instruments. That means they come at very low cost or no cost, okay? And then they are settled at a future date. And lastly, their value is dependent on an underlying item, right? On an underlying item. So this is what we mean by a derivative. And for the accounting treatment of derivative, we keep it under fair value through P&L. So we take them to their fair value at each reporting date with a gain or loss being reported in P&L. Now, there's a concept when a non-financial instrument can also be a derivative. Yes, there's a concept when a non-financial instrument can also be a derivative. Generally, a derivative is a financial instrument. For example, a share option, right? So share option means an option to take shares. So that is a financial instrument. But a non-financial instrument can also be a derivative only if it is settled net in cash. Something settled net in cash either by contract or the past practice. So there's a past practice that we always settle it in cash only, or we are going to take delivery of the derivative, okay, and we are going to sell it and sell it immediately. Sell it immediately. So that can be an aspect, okay. So we have to basically see whether it is settled net in cash or not. Secondly, sometimes there is a derivative, something which has a characteristic of derivative, but used in business. So you have a future contract to buy electricity that you will use in your business. So you're basically using it for your own purpose, own use. In that case, it is not a derivative, rather it is an executory contract. So you don't record it today. The day you execute it, that's when you will record it. So for example, a future or a forward to buy electricity for your own use. So if you are just trading with it, that okay, I want to speculate that what will be future electricity prices. So today I've fixed the prices by entering into a future option or a forward contract. So in that case, it's a derivative. But if you want to take delivery of the electricity and you're not speculating or gambling with it, then it is an executory contract. Okay. And we've done questions on it. So you can try questions. For example, we have this question of, I've just forgotten the name. Carsoon company is there for that fair value through OCI debt instrument. Then we have a question on executory contract as well. I'm not able to recall the name, but we have done it in Super 20. And then we also have outright company question for hedging part that we are still to do. So Carsoon, outright, these are the two questions which you can practice. Let's come to hedging part of, or the last part of IFRS 9. Hedging. We'll keep it very short, simple, and cute. Something that we can practically remember, not making it very complex. See, hedging is simple. What you can be asked is that when do you record it under hedging? Because when hedge rules apply, no other standard is applicable on the particular hedged item and hedging instrument. So there are two things. One is there is a hedged item which you want to hedge, and one is through which you're trying to hedge it. So hedging instrument. So basically trying that, okay, I'm trying to protect myself from certain fears, which is why I'm entering into some transaction or I'm buying some derivative where I'm betting against my fear. So hedging is basically betting against fear. So you're betting against your fear, right? Now, you will apply hedge rules only if the hedge is formally documented, where you have identified that which is the hedging instrument and which is the hedged item, and the hedge effectiveness criteria is met. Hedge effectiveness criteria is met. Now, how do I know whether hedge effectiveness criteria, what is hedge effectiveness criteria? That's a question. What is hedge effectiveness criteria? This is a direct question that can be asked. It was actually asked in outright company. So hedge effectiveness criteria is when the hedging instrument and item have, when the hedging instrument and item have inverse economic relationship. That means the value of one will increase and the value of other will decrease. That's only when you can set off the gains and losses and come to a situation of no profit, no loss, right? Second is the hedge ratio is apt. Then the fair value of hedged item is not dominated by the credit risk. So generally, a hedged item can also be your commitment to pay in future, right? So maybe a payable. Your hedged item can be a payable that you've recorded. Now there's a credit risk also that maybe you will not have money in future and you might not end up paying. So your hedged item's fair value should not be dominated by that credit risk because you are betting against your fear. So you're entering into a hedging instrument, right? You're buying a derivative. So let's suppose you are having a fee due to ACCA at the end of the year in pounds. So you are fearing that your exchange rate between your domestic currency and the pound might change unfavorably and you might end up paying more. This is your fear. So to bet against your fear, you enter into such a derivative that if the foreign exchange rate changes unfavorably, you'll make a gain there. So that's how you set off your gains and losses. So if in one transaction you'll make a gain, on the other one you'll make a loss and you will have a no profit, no loss situation. But if the fair value of that payable is going to change because you might not end up paying only, then this hedge will become ineffective. No. So it's a very small thread through which the hedged item and hedging instrument are bound with each other. And that thread is that underlying item. So basically the third point is saying that don't let credit risk cloud the underlying factor. The underlying factor here is exchange rate. Don't let credit risk dominate that so that there can be a clear inverse economic relationship, right? So this is hedge effectiveness criteria. Then we have two types of, you can say, hedges. One is fair value hedge, another is cash flow hedge. Generally, it's given in the question that which hedge is being followed, but as the name suggests, if you're fearing about fair value change of an asset or a liability, then it is fair value hedge. If you are fearing that you might end up paying more or less cash, then it is cash flow hedge. Now, what is the accounting treatment for fair value hedge? Let's understand that. See, for the fair value hedge, you take the hedged item and hedging instrument. You take the hedged item and hedging instrument to its fair value at each reporting date. Okay, that's for sure. And then the gain or loss is reported in statement of profit and loss. But there is only one exception. And that one exception is if the hedged item is equity instrument kept under fair value through OCI. Then in that case, the gain or loss will go via OCI. Otherwise, it will go via P&L only. That's the simple rule for fair value hedge. This is what we should remember, okay? This is practically possible that we can remember this. That too after a lot of struggle. So let's not go into so much depth of hedging because they don't test you on hedging for so much depth. Even the real-time accountants, they don't know that much depth. So this is like sufficient. Then cash flow hedge. In cash flow hedge, we have again, we have to take the hedged item and instrument. They are taken to their fair value. Okay. And again, here what we do is we calculate that what is the effective portion and what is the ineffective portion. So effective portion and ineffective portion. So how do we decide what is the ineffective portion? So if the fair value movement of hedging instrument is greater than the fair value movement of hedged item. So I gave you an example in the class of younger and elder sibling. So it's like, I'm the younger one, by the way. So it's like the younger sibling was brought into the world because the elder one was getting bored. So similarly, the hedging instrument was brought into the world because we wanted to hedge the hedged item. So now the hedging instrument should not fluctuate more than the hedged item. But if it does, then it is going to be ineffective portion. So the effective portion is going to go via OCI and the ineffective portion is going to go via statement of profit and loss. That's it. This is what we have to keep in our mind for cash flow hedge. That's the end of IFRS 9 with all the advanced aspects ranging from impairment, loss allowances, credit impairment, derivatives, executory contract, hedging, and the two types of hedges and their accounting treatment. Okay, if you are not clear about it, again, you can just move back in the live video and rewatch that portion. Now we'll take a short break, okay, for the FR students also. They can come back and join the video after the short break where we are going to complete group accounts. So we'll take a short break here and we are going to come back to our session after 5 minutes. Okay, so just take some time to soak in IFRS 9 until we are back after the break. Yes, guys, I hope I'm audible to you. Let's resume the session. Okay. Just confirm to me once if I am audible. Let's get started with group accounts, which is basically from FR and SBR perspective both. So let's see. Yes, we will do IFRS 2 and IS 19. That is towards the end for SBR. Okay, let's first complete group accounts. So basic group accounts, first of all. Okay, so basic group accounts. See, we have 5 working notes here, as per which we have to create basic group accounts. Now, uh, the 5 working notes that we have is for statement of financial position, group statement of financial position, right? Okay. Now, the rules as per which we have to consolidate is we have to add up everything. We have to add up every asset and liability at 100% as if we own everything. Then we have, we have to show we have to eliminate some intra-group transactions which might exist. So eliminate intra-group transactions slash balances. And then we have to show up to the extent, show up to the extent we don't own the subsidiary. We don't own subsidiary. So that is basically we are going to show our NCI component, the extent up to which we don't own the subsidiary. Then we have our 5 working notes. So we'll just discuss 5 working notes. Of course, we can't practice questions here full-fledged. We have done a lot of them. So we are just revising that how a group statement of financial position is prepared. So the 5 working notes, first of all, we have to see that, what is the group structure. Within that, from SBR perspective, not FR, we have to sometimes see who is the acquirer. So generally, the acquirer is the person who is the bigger entity, the ones who issue shares, the ones who pays cash, the ones who's going to appoint majority of the board of directors, the person who's going to have basically more voting rights, majority of the voting rights, that is person who is the acquirer, right? And then we have to settle the relationship that who is the parent company in a situation and who is the subsidiary. This first working note is useless for FR people, but for SBR people, yes, it is useful because we get to know who is the acquirer, right? Then what we have is second, is our fair value of identifiable net assets of the subsidiary. So we have to take the net assets of the subsidiary into account. So we take the fair value of net assets of the subsidiary at the date of acquisition. So at the date of acquisition, we have to take into account, and we have to take that into account at the reporting date, right? So at reporting date as well, we have to see the net assets of the subsidiary, and whatever is the movement, whatever is the movement. So how the net assets have changed from date of acquisition till the reporting date, that is basically in which the subsidiary is going to, or the parent is going to have a share, right? So we have to take the net assets at the acquisition date and at the reporting date. Now, what are the net assets? Net assets are share capital of the subsidiary. Then you have share premium. It can be the you know you could have your another net asset example. It could be your you know the other components of equity. You can have some retained earnings here. So you see what were the retained earnings at the date of acquisition of the subsidiary, what was the retained earning at the reporting date, and the difference between the two is the movement in which the parent and NCI will have their share, right? And then if there is a fair value adjustment, here it will happen in both the columns of at the date of acquisition and at the reporting date. Because of the fair value adjustment, there can be some additional depreciation, and that is only adjusted at the reporting date column because that's an year-end expense. So additional depreciation on the date of acquisition can't be charged because the day you record the asset, you don't depreciate it. You record it at the end of the year, right? So that will be just there in the reporting date column. Okay. Then finally, what we have is working note number 3 that relates to goodwill. Now, there are two types of goodwill, full goodwill and partial goodwill. What is the formula to calculate goodwill? You first take the fair value of consideration paid by the parent. Consideration paid by parent. Now that can be a cash consideration, it can be a share for share exchange, it can be a deferred consideration. In that case, I will have to calculate its present value and create a provision. And whenever I calculate present value, I'll have to in future, I'll have to unwind the interest. Okay. Then we have the you know Yes, DTA, DTL, all are there. These are all additions. We can't consider everything in one go, right? That is something that you know from your practice. So I'm just giving you the basics. So deferred consideration, present value, and then unwinding of present value is also there. Then what we have is contingent consideration. Sometimes we end up paying the basis of some probability. So that has to be taken on the most probable amount, right? Then what we have is NCI's value. Now we take NCI's fair value for full goodwill calculation, but if it is partial goodwill, then we take NCI as a percentage of working note number 2. That means fair value of net assets of the subsidiary at date of acquisition. We take NCI as a percentage of working note number 2. So that depends whether we are calculating full goodwill or partial goodwill. So this one is full. Okay, this one is partial. Okay. Then we compare this with what is the worth. So less. What is the worth of the subsidiary? So we take fair value of net assets of subsidiary at acquisition date. So we deduct it from here and we get our goodwill on acquisition, which is further impaired or not, that is given in the question. So this is a formula to calculate our goodwill. Okay. Then comes the question that sometimes, when we have to, this is an SBR concept, that if you have calculated partial goodwill and as per IS 36, you want to impair that partial goodwill. So as per IS 36, we have to compare the carrying amount with recoverable amount. So partial goodwill means partial goodwill. That means it's not 100%, it is partial. So carrying amount is partial, but recoverable amount comes from the market, which is at 100%. So in that case, I have to calculate total notional goodwill for the calculation of real impairment and its correct allocation. So I might have to calculate total notional goodwill using unitary method, where I can say if partial goodwill, that maybe, let's suppose parent share is 80%. So if 80% of goodwill is this, 1% will be this and 100% will be this. So total notional goodwill, I have to use unitary method. If you want to practice this concept of total notional goodwill from SPR perspective, you can try the Luploid company question. Okay, this is there in your Kaplan kit. This has a concept of total notional goodwill, right? So this is just a small touch of concept that I've done, that yes, total notional goodwill exists. So this is our goodwill working note that we use as a base or a framework. Of course, as per the case study, things change, new information is added or deleted. So we have to alter that according to the aspect given in the case study. Then comes working note number 4. That is basically NCI. So if you have used partial goodwill method, so whatever NCI's value you've taken in working note number 3, you'll use it here as it is. Then you will show NCI share in post-acquisition movements of net assets of subsidiary. So post-acquisition movement is coming from working note number 2. So you'll take that as it is and show NCI share in that. Then if there is full goodwill which is impaired, then NCI's share in goodwill impairment, especially if there was full goodwill, right? And then you get NCI at reporting date. Finally, working note number 5. In working note number 5, we have group retained earnings. So group retained earnings, we start with parents retained earnings. Then we show parent's share in post-acquisition movement of net assets of the subsidiary from working note number 2, right? And then we show if there is any, for example, unwinding of interest. So that is deducted from here. Okay, if there is any PURP, that is also adjusted here. We'll talk about PURP later. So there will be a lot of stuff as per the question which can be adjusted here. Okay, so generally parents retained earnings plus parent share in post acquisition, unwinding of interest can be deducted, or parent share in goodwill impairment, parents share in goodwill impairment. Okay, that can be deducted from here. And then you finally have group retained earnings at the reporting date. This is the basics of 5 working notes which are applicable to both FR and SBR. Now comes the intra-group transactions, okay? Some special transactions which are to be eliminated. See, if parent is the seller, I'm telling you just from the perspective of the balance sheet. If parent is the seller, parent sell goods to the subsidiary. Now I have to eliminate the PURP. So PURP is only calculated on the inventory which is still there in the warehouse. Okay. So if parent has sold goods to the subsidiary, so parent has recorded an unnecessary profit. So that has to be removed from group retained earnings. So GRE debit. Okay. And subsidiary has recorded overstated inventory. So inventory credit. Right? So GRE debit, inventory credit. If parent is the seller, that's our journal entry for PURP. Also, always remember that markup, okay, markup is always on cost and margin is always on selling price. Just remember that. Markup is always on cost and margin is always on selling price. Okay. Then if subsidiary is the seller, if subsidiary is the seller, then what happens if subsidiary is the seller? Now subsidiary has recorded unnecessary profit. But the point is that in subsidiary's profit, parent and NCI, they have their share. So our journal entry will be GRE debit by the share of parents' profit and NCI debit by the share of NCI's share in PURP and group inventory credit. Now, if you want to decrease GRE and NCI both, what you can do is you can adjust your working note number 2 reporting date column. By that, automatically the impact will be there in the post-acquisition movement, and automatically that impact will be shared between NCI and GRE in their own percentage share, right? So GRE debit, NCI debit, inventory credit, that's what happens if subsidiary is the seller. Okay. Then finally, when we are eliminating intra-group transactions, sometimes there can be a situation that due to temporary differences, for example, the goods are still in transit, the cash is still in transit. So, for example, I'm just taking a hypothetical example. Parent sold goods to the subsidiary, okay, and the goods are still in the transit. So, parent has recorded a sale and it has recorded, therefore, a receivable. But subsidiary has not yet recorded equivalent payable, right? So now I cannot cancel out the receivable with the payable because I'm supposed to eliminate the intragroup balances also, no? But now they are not there by the equivalent amount because the goods are still in transit. This is a situation of goods in transit. So what can I do in this situation? The subsidiary will have to, understand here that goods are there in the transit. Let us record the entry as if the goods are received. So subsidiary first will record the receipt or will record a journal entry as if the goods are received, as if the goods are received. So for that, what will the subsidiary do? The journal entry would be as if the goods are received, purchases debit, payable credit, and then finally, now the equivalent amount of payable and receivable will be cancelled as intra-group transaction, right? That's it, or intra-group balance. So this is what we have from statement of financial position, basic group accounts. Okay. Then we also have a standard on associate, that is IS 28. So sometimes we don't have control over a company, but rather we have significant influence, that is a power to participate, right? So as per IS 28 for associates, in the balance sheet, we record the cost of investment in associate. Okay. So how do you record it? You show your share. First, you take the cost of investment, that means the purchase price. In that, you add the share of profit in associate. From that, you deduct whatever you've received. So dividend received from the associate. Okay. So purchase price plus share of profit in associate minus whatever we have received, dividend received. So this is how we show cost of investment in associate in the balance sheet. And we just show it as a separate one line item, right? And in the P&L, we just show share of profit in associate. That's what we call as equity method of accounting. Equity method of accounting, where we are just showing one line for the associate, right? And for the statement of profit and loss, group statement of profit and loss, I'm not going into the detail of it. Just you should know that here we time a portion, that okay, what is the date of acquisition, and only the post acquisition income and expenses are consolidated, not before that. So only the post acquisition income and expenses are consolidated. Okay. And you do time apportionment, and then you also show that what is parent share of group P&L and what is NCI share of P&L, right? And apart from that, there is, of course, if there's an intra-group transaction, you have to remove the PURP, right? So if there is intra-group transaction, we have to remove the amount of intra-group transaction from revenue and COGS, because cost of sales include purchases, add the PURP to cost of sales so that the profit is removed. Because if you increase the cost, of course, the profit will slash. This is what we will discuss from group P&L. And this is what is there from FR perspective of basic group accounts or total group accounts. And this is enough for FR students. Okay. So at this point in time, the FR students can leave the session. And this one is just something which overlaps between FR and SBR. Now, from here onwards, whatever I teach is going to be from SBR perspective solely, where I'm going to move on towards advanced group accounts, where we're going to discuss change in group structure, foreign subsidiary, and the statement of cash flow. Okay, so just from the SBR perspective now, let's move on to change in group structure. We'll not take much of the time to it because it's a very, even though when we were studying it, we did it thoroughly, but now when we are revising it, it's very simple. So change in group structure, guys. What happens in change in group structure is that we are climbing up the ladder or we are coming down the ladder. So I hope you remember the ladder that I always draw, and this is a golden door of control, right? And if we, let's suppose this is 0%, this is 10%, this is 50%. So if your voting right is between 0 to 10%, 0 to 20%, okay, then this is a normal investment as per IFRS 9. If your shareholding is between 20 to 50%, then it is associate. But the moment you cross this door of control and you cross 50%, till 100%, then this is the situation of parent and subsidiary. Now, this is not necessary that I'll just move from 0 to 50 or 60% directly. I might climb up the stairs by steps, or I might come down the stairs in steps. So this is a situation of step acquisition and step disposal. So let us understand the step acquisition and step disposal. What happens here? Okay, so let's move on. Step acquisition, first of all, there are two situations where we might move from no control to control. So we are saying bye-bye to one standard. For example, we are saying bye-bye to the, let's suppose it was an associate, now it is a subsidiary. So we are saying bye-bye to IAS 28 and hello to group accounts. So what we do is we take the fair value of associate with gain or loss reported in P&L, and then we de-recognize the associate by debiting goodwill. So basically your entry is goodwill debit and associate credit. So you calculate goodwill on acquisition. How do you calculate it? You will take fair value of associate, the previously held interest. Then you will say what was the fair value of consideration paid to acquire the extra shares. Then NCI minus fair value of net assets of subsidiary. Fair value of net assets of subsidiary. Simple formula of goodwill. And you get goodwill on acquisition. So when you move from no control to control, you have to simply do the goodwill calculation and start with the consolidation process. Second aspect or second scenario is in step acquisition when you're moving from control to control. So for example, you had 60% shares, but now you have 80% shares. So this is basically decrease in NCI. This is not going to lead to any goodwill calculation or recalculation. This is simply a decrease in NCI. And how am I going to calculate that decrease? I will take NCI on date of acquisition and I'm going to apply unitary method to it. That if, let's suppose 40%, right? With 60% control, 40% is NCI. If 40% of NCI is whatever amount is given, then 1% will be X divided by 40%. Then of course, I want to calculate 20%. So 20% would be X divided by 40% into 20%, right? So this is the unitary method that you apply and you get the decrease in NCI. And what is your journal entry to record the decrease? Now NCI is reducing. So NCI is a credit balance. So if it is reducing, NCI debit, and you are also paying something because you're getting control. So you're paying something to get that extra shares. So money is going out. So bank credit. Yeah. And NCI debit, bank credit, and the balancing figure goes to other components of equity. If it is a gain, it will be on the credit side. If it is a loss, it will be on the debit side. So other components of equity, balancing figure. Next, what we have is a situation of step disposal. So let us understand the step disposal where we have the situation of from control to no control and then from control to control. Let's first discuss control to control. Here also again, the NCI is basically increasing. So you are moving from, let's suppose, 80% to 60%. So now your NCI is increasing. So same unitary method will be taken. This is increase in NCI. So your journal entry will be that, okay, but this time you're disposing, so you're going to receive money. So bank debit, NCI is increasing, NCI credit, and the balancing figure goes via other components of equity. That's it. So this is what we have for increase in NCI, right? Okay. Next, in the step disposal situation is when I'm moving from control to no control. When I move from control to no control. So this is very simple but important. Here, basically, what we do is we calculate the gain or loss on disposal. Okay. So when we are moving from control to no control, first of all, I'll have to deconsolidate. That means I will have to stop the consolidation. And I'll have to calculate the profit or loss on sale. For that, I will apply the happy sad formula because I still have some kind of interest left in the subsidiary. So I'll first take that how much money have I received by selling this subsidiary. So the proceeds, I'm happy about it, right? So we are happy about it, proceeds. Then we are going to add into it, of course. Why add? And what? We are going to add into it the NCI at disposal date. Why disposal date NCI is added? Because NCI is a headache to you. You always have to share your results with the NCI. Now you are removing the NCI, you are de-recognizing the NCI, so you're happy. Then you're going to deduct or you're going to add whatever is the retained interest. So fair value of retained interest. So it's basically like you have sold the subsidiary, but still you have some interest in it. You're still going to receive share of profits. So you're happy about it. So fair value of retained interest added. I am going to deduct from it the fair value of net assets of subsidiary at disposal date. Of course, if net assets will be removed, I'll be sad about it, no? That, now the net assets of subsidiary are no more mine. So I am sad about it, so deduct it. Then I'm going to remove from it goodwill at disposal date. Of course, because goodwill is a good thing, but if I've sold the subsidiary, I'm not going to get any more benefit of the goodwill. So I'm going to deduct it. I'm sad about it. Now I will see in net whether I'm happy or whether I'm sad, right? So in net, we're going to get either a profit on disposal or a loss on disposal. That's it. So this is how you calculate your profit or loss on disposal when you move from control to no control. Very simple, easy chapter or concept of change in group structure, where we have aspect of step acquisition and step disposal and 4 scenarios. Then what I have is group foreign exchange. Now guys, in group foreign exchange, you should know what is a functional currency. So functional currency is the currency of primary economic environment, right? And generally in the question, it's given to you. But sometimes when they ask you a direct 5 marker that what is the functional currency, so in that case, you can refer to like the rules. So there are primary factors to determine the functional currency, and then there are secondary factors. Primary factors are the currency in which you quote your selling price. So the currency in which the selling price is quoted is your functional currency. The currency in which direct costs are incurred is your functional currency. The currency in which your competitors are operating is your functional currency. The secondary factors are the currency in which loan is taken, the currency in which indirect costs are incurred, right? So these are secondary factors. Now, if we talk about a situation of parent and subsidiary, generally, parent's functional currency is same as subsidiary's functional currency. But if it is not, then if subsidiary is dependent / not autonomous from the parent, then forcefully subsidiary's functional currency is considered to be same as parent's functional currency. But if subsidiary is autonomous, Then I need to determine, then using primary and secondary factors, subsidiaries functional currency is determined. Now, parents' functional currency and subsidiaries' functional currency are separate. So I need to do some kind of retranslation for consolidation. I can't consolidate, dirhams with dollars or Indian rupees with dollars, right? I will have to maybe, retranslate. So there are certain rules of retranslation. So you retranslate the results of subsidiary into parent's functional currency. So all the assets and liabilities of subsidiary are retranslated using, come on, which rate is used? Closing rate. And all income and expenses are retranslated using average rate. And because of this, there is always a balancing figure, or there's always a gain or loss which arises. And that gain or loss on retranslation goes via other comprehensive income, which is reclassified to P&L only when the foreign subsidiary is sold. So these are the rules of retranslation of a foreign subsidiary, right? That's it. This is what we have for foreign currency or foreign subsidiary. Okay. Now, if you want to try questions on group accounts, you can try Columbia Company. You can try for basic group accounts as well. You can try Ashanti Company. That might not have pre-populated spreadsheet, but still very important. Also in the description box, when I'll add my notes, I'll also add the link to a PDF of how to pass the pre-populated spreadsheet. So I've given you journal entries of all the situations of group account. So you can just have a quick go through, okay, of the crux to pass pre-populated spreadsheet. So you can try Columbia, Ashanti, and you can try this banana company for the statement of cash flow. Yeah, so you can try these 3 questions. If possible, please try this sugar company as well. Yeah, that's it. So these are the questions that you can try. Of course, Super 20 is there, but just for extra revision if you want, if you are like, still not sure about it, so you can try these questions. Now the statement of cash flow, group statement of cash flow, I don't have much to say or revise about it. We just have indirect method of cash flow preparation. And that's basically more about application. But there are certain things that, maybe some special adjustments that I can discuss with you from group statement of cash flow. So basically in group statement of cash flow, we are preparing parent and subsidiary both statement of cash flow together. So we are using indirect method, same way, cash flow from operation, cash flow from investing activity and financing activity, the format is same. The only difference is that, for example, if you have a cash flow for purchase of subsidiary or acquisition of subsidiary, or you have a cash flow for disposal of subsidiary, so you take the cash flow at net amount. So you basically see how much have you paid to acquire the subsidiary versus how much cash is the subsidiary bringing along, versus how much cash you have received from the disposal of the subsidiary and how much cash has gone with the subsidiary. What was the bank balance of the subsidiary? So you take it at the net amount, right? And of course, then you can make T-shaped accounts of a lot of stuff. For example, for PP, you can make T-shaped account to know what is the actual purchase or disposal of PP. Similarly, if there is an associate, you can make a T-shaped account to know what is the dividend paid to the associate in cash. For tax, you can make a T-shaped account to know what is the actual tax paid. For NCI, you can make a T-shaped account to know that, okay, what is the dividend paid to NCI. So this way you can calculate the real cash flows by making various T-shaped accounts, right? So group statement of cash flow, this does not have a basic concept to it. It's more about application. So you can try banana company and be okay with cash flow. Of course, you would have done a lot of questions in Super 20 as well. So that is it about group accounts. I hope I am clear to you. It was quite quick, but that's how group accounts is. I would say group accounts is more about application, practice, rather than about the concept. But whatever was the principle behind the theory, I've explained you that. Now let's move on with the last two standards for the day. Okay. Again, as I said, we're not doing 100% of the IFRS, but almost all the important IFRSs. So the last two standards for the day from SBR perspective is IS 19 and IFRS 2. So let's talk about IS 19, employee benefits. So employee benefits, guys, there can be like pension. There can be short-term benefits, long-term benefits, post-employment benefits, but mostly you're asked a question on post-employment benefit, that is on pension. So we talk about defined benefit contribution scheme. There's a defined contribution scheme also, but this is widely tested, defined benefit scheme. Now here what we have is, we have a situation of that we have some pension obligation, and to meet that obligation we have already invested into a planned asset. So we have a situation of either a surplus or a deficit. So let's take a situation of net surplus. In case of surplus, okay, let's take a situation of deficit. Surplus is very rare to find. Deficit, that means my planned asset is shorter than the pension obligation. So there is some interest component, there's net interest component which is added to it. So net interest component is basically, the increase in pension obligation, right? So that is added to the deficit. Then what you have is, you have the service cost, which can be current or past service cost. Okay. So if there is any gain on settlement, loss on settlement, or there is any gain or loss because of amendment, settlement, or curtailment, all of that goes via service cost only, right? So service cost generally also increases the obligation. That's why it is added to the deficit. Then what I have is, I have the contribution made into the planned asset. Now contribution into the asset is increase in asset. So if my asset increases, my deficit will decrease, right? Then I have the benefits paid out. So benefits paid out are basically, I pay out the benefit out of my pension, or out of my pension obligation, or you can say out of my planned asset, I pay out my pension obligation. So all in all, there is nil impact because of this. There's no impact of benefits paid out. So there's a net deficit in which you add net interest, in which you add service cost, from which you deduct contribution. Then you have a closing deficit, the value which is given to you by an actuary. Now that will not match the value that you calculated above, due to which there will always be a balancing figure that will arise, which we term as remeasurement component. And this remeasurement component goes via other comprehensive income, right? This remeasurement component goes via other comprehensive income and is never reclassified to statement of profit and loss. This is what we have from IS 19 basic employee benefit. Then there's also concept of where you have a surplus. So you have a concept of asset ceiling. So sometimes in the question it will be given that there is an asset ceiling. So asset ceiling is when you have a surplus, but you seal it that okay, I can only show the I can only show the surplus up to this extent. So when you reduce your surplus, that also goes via OCI. So your entry is OCI debit and my asset credit or my surplus credit, right? So asset ceiling is you seal your surplus because you are prudent. You're like, okay, I don't know if this much value should be allocated to the surplus. That's it. So this is what you should know from IS 19 for the questions following. Lastly, you have IFRS 2. These standards seem bulky, but actually they're very small, okay? If you go by its concept. Share. Now, there are two types, broadly, there are two types of share-based payment. One is equity settled share-based payment. Second is cash settled share-based payment. So when you issue share options to your employees or shares to your employees, that is equity settled. But when you issue cash settled, that is basically SARs, where you give them share appreciation rights. What are share appreciation rights? Where you basically say that as and when the share price will increase, according to that, I'm going to pay off cash to the counterparty. So I'm giving that right to the counterparty that as and when the share price will increase, accordingly, you will get cash. So how do you account for both of them? See, in equity settled, your journal entry to record it is expense debit and equity credit. So basically, you're giving share-based payment to your employees in most of the situations. So giving salary to employees is an expense, right? So expense debit, equity credit. For cash settled, your journal entry is expense debit, but this is not equity. It is rather a liability because you're going to pay cash. Now, how do you calculate the expense and the equity? There's a formula. You have to take number of share options granted into number of employees who are going to get this, right? Into number of employees you're going to who are going to get share options into fair value of share option at grant date, right? And this is going to give you, so let's suppose the vesting period is 3 years. So let's suppose this is first year out of the 3 years. So this is how I will calculate it. But in case of cash settled, the only difference will be I'll take number of SARs issued into number of employees who get it. But this time I will take fair value of SAR at each reporting date. Instead of grant date, I'll take it at each reporting date and same 1/3. So this is the formula for equity settled and that is the formula for cash settled. Now I used the term vesting condition. So there are two types of vesting condition, market and non-market. So vesting condition is the condition attached with the share option or the share appreciation right. If there is a market condition, we ignore it because that is already discounted in the fair value of the share option or the SCR. If there is a non-market condition, then this impacts the number of employees who are supposed to get the share option or the SCR. Right? That's it. So this is the concept of IFRS 2 that you shall remember and IS 19 that you shall remember. And this is what I wanted to revise with you today. Of course, for example, we did a lot of questions in Super 20 about operating segment. So you know about operating segment. IS 37, provisions. You know that a provision is created when it is probable outflow. Otherwise, a contingent liability is disclosed. Contingent asset is disclosed if it is probable, or a contingent asset is recorded when it is virtually certain. That sums up IS 37. IS 10, events after reporting period. Adjusting event, non-adjusting event. If the evidence existed that yes, this event is going to happen at the reporting date, it becomes adjusted, otherwise non-adjusting, right? Then IS 24, related party. You have to show if there's a related party that what was the nature of transaction with that related party, what was the timing, whether it was at arm's length or not, right? So these are the major crux of standards that we have from our SBR. And if you ask me about EPS, honestly, EPS will not be tested for SBR. Okay, EPS, you will be might be asked about the theory of EPS, that how EPS is an important measure, or there will be EPS calculated in the question in question number 4, and they will give you some mistakes made by the accounting standard, and they'll ask you to recalculate the EPS and the formula is already given to you. So don't get into the explanations or calculation part of EPS as such at this end moment. If you have not already done it, you can just have a read through of it. You know, what is important is EPS discussion, not calculation. Calculation is there in FR, not SBR. Okay. So I don't know, Shravani, if you are from FR or SBR, but if you are till here, I'm supposing you are from SBR. So in SBR, EPS is not that important a concept. Okay. Then IFRS 11. Yes, what's there in IFRS 11? We have two things, joint venture, joint operation. What is a joint venture? When two or more companies, they come together and they create a separate legal entity. Okay. And they come together and they create a separate legal entity. Plus, they say that we are going to have unanimous voting. Unanimous voting means until and unless everyone agrees, okay, we are going to, then only we will go ahead with this decision. So everyone will have a say, right? So that is unanimous voting. Then joint, that is joint venture. And how do you treat a joint venture? As per IS 28, equity method of accounting. What about joint operation? Joint operation is basically, for example, you say, ma'am, you teach, I will handle the portal. So let's handle the operation of teaching together. Let's suppose TGP has a lot of other stuffs as well, but one part of it is teaching. So we are just handling one operation together, right? That is a joint operation. So you record your share of income and expenses, and I'll record my share of income and expenses. There's nothing like we have share in our assets and liabilities, right? That is IFRS 11. Crux. Then IS 12. Okay, you want me to give you IS 12's crux? See, IS 12 is about deferred taxation. Current tax is like LOL concept. So I'll just talk about deferred tax concept. This arises because of a temporary difference. Now, if your current carrying amount is greater than the tax base, so you pay tax on the basis of tax base, correct? That means you are paying less tax today and tomorrow you'll have to pay more tax. So this leads to DTL, deferred tax liability. And if the carrying amount is lesser than the tax base, that means you're paying more tax today. So you'll have to pay less tax tomorrow. So this is a DTA. Both DTL and DTA are created via statement of profit and loss, right? And then there is a concept of unused tax losses, which is important because that is like tested widely. So unused tax losses, what happens is they say that, for example, the tax losses are made by a company. Now, on those losses, we don't charge tax. Rather, we can carry it forward to the future to get a deduction for it from our future profits so that we pay less tax tomorrow. So, uh, you know, there should be a solid evidence. There should be a solid evidence if, there should be a solid evidence of future taxable profits. Okay. So this solid evidence should be from outside sources. Okay. They should not be from inside sources. So they should be external evidences. For example, market research, a customer contract, etc., not budgets predictions. So there should be solid evidence. Then only you will create a deferred tax asset for the unused tax losses. Now, this is what can be widely tested from IS 12. And generally in SBR, whenever in consolidation, in working note number 2, you make fair value adjustments, that generally automatically gives rises to deferred tax implication. So if fair value of an asset is increasing, this will create a deferred tax liability. But if in the question they have mentioned that ignore deferred tax, that's when you will ignore it. Otherwise, you'll always take that into account. Right? So you've done questions wherein fair value adjustment, deferred tax implications were arising. Right? This is what is widely tested from IS 12. I hope I'm okay on that. Agriculture, biological assets, you can skip on to it, but I've tested that in one of your mocks. So that was explained in the debrief, right? So you can just go through that. IS 41, even though that is like ignored in SBR, they don't ask you questions on it. But just in case they do, I had put it up in the mock so that you can get a chance to revise it, even though it's an assumed knowledge from FR. But it is okay. I just put it in the mock to you to have a surprise element or to be able to revise it in case, it comes up. But the probability of it is like 2%, 2%. Okay, so just skip on to that. If you're given the mock, you can just go through the debrief of the mock. You'll find the concept there. Right? Okay. Now, guys, IFRS 13, I assume you guys would know. I'm not going to explain such basic standards to you. About the current issues and technical articles, there's a proper playlist on my YouTube channel. So you have current issues video, which was uploaded like I would say it was uploaded in 2023, but it is still valid. There is no change to it. The additional current issue, that is IFRS 18 and 19, that has been posted recently in the live section of my YouTube. So if you search IFRS 18 and 19 on YouTube, you will find my video on that. Okay. So you can just try that and you can watch that. Okay. And technical articles, there is a playlist on the YouTube channel. And of course, if you are coming from my course, you have the technical articles, video debriefs uploaded on the portal. You have to just go through that, right? So that's it. And also the notes from today's word plus the PDF that I was talking about will be shared with you in the WhatsApp group if you are part of the course. Otherwise, in the description box, you'll find it after a few minutes once the video is uploaded, right? So this is what I wanted to share with you today and discuss with you today. Now, let me just give you some basic tips, okay, general tips apart from the concepts and all. So what to do in the remaining days? I don't think we have much days remaining, right? But still, what can we do to make sure that we are good, right? I would say, guys, the right time to stop practicing would be around 1st of December, okay? So it's like, or, just maybe 1.5 day before your exam, you will not practice. You will not do any mock. You should only be doing your revision of standards. For example, today we did revision of many standards. You might feel like, oh, this is left, that is left. But what is the most important one? That is what we've revised. If you pick up a paper, you will mostly find group accounts in it. You'll mostly find IFRS 9 in it, IFRS 16 in it, IFRS 15 in it. You'll find IS 19 and IFRS 2 in it. These are the basic overview standards of SBR. Rest, we have a lot of crowd, but that is manageable, right? IS 37, IS 10, IS 2, for that matter of fact, IFRS 11, but we still had a brainstorming session on it. But the point is that we have done basics, the crux, something that we have, like this is you should know if you want to pass the paper. This is something that you should never forget. These are the concepts, if you know, you can easily pass, right? Now, apart from that, if you have more things in your head, if you have more, queries and things, you will do the revision of the concept in that last 1.5 day. Right now, you will do practice as much as you can. That's my suggestion, sweet suggestion, if you want to apply. Otherwise, you have your own brains and strategy. Now, in the practice, you must have done Super 20 so far. I am assuming that, but if you've that last minute study person, uh, then you will be putting like 10, 12 hours a day. So, of course, you can manage it still. There's nothing has been harmed as far. We just need a 51 to pass, right? So there's nothing like you should give up. You still have time, okay? So there are so many instances from my journey as a student when actually I've studied 10, 12, 14, 15 hours a day when I was studying like towards the end. So I was also by force, okay, because I had a lot of other exams to handle from my board exams. I had to study end moment, but then I was able to manage it. Now, point is, I'm not flexing it. Point is that if I can do it with that level of mind when I was a kid, you can also do it when you are a working professional. You have the knowledge from FR. You have attended this session. Back in my time, there was no tutor for SBR as such on YouTube. And so, if you have that knowledge, if you have that resource, towards the end also, if you put the pressure on yourself and you do hard work, instead of being anxious, instead of being, having a nervous breakdown and, just having that kind of blanking out situation, if you take this maturely, if you do this with, like, I would say, more focus rather than overthinking, you'll be able to manage this situation. So you'll just do practice till the 1.5 days remaining. Post that, you will just do revision. Now, practice, I've given you some questions during the session today. Or if you don't want to do that, or you have already done that, you can pick up random past papers. Even for 2 days, if you pick up two random past papers, I've already given you mock. First of all, give that mock. Okay. After that, if you have time, pick up two random past papers. Then the first mock or the first paper that you write will always be a shocker. It will never be like, okay, I'm passing very easily in that. It will never be. The people who got 90 or 90 plus in my courses, they have also never, got a very promising score in the first mock. So don't get disheartened by that. That's just a process. That's just to give you a reality check. Sometimes we are just uh, taking things for granted. We're like, okay, we'll pass, we know this, we know this. But sometimes we've not done enough practice and we realize it. And that's just for your realization that maybe you should do more practice. Now, once you got that realization, do at least two more past papers. One of them could be your pre-mock, okay? Without looking at the debrief or without looking at the answers, you can attend the pre-mock by ACCA and then attend its debrief by ACCA. It's very important that you attend it by ACCA only because they are the people from the examining team, right? So let's listen to them, okay? So you can just watch the debrief by ACCA. Let's complete the debrief by ACCA for the pre-mock. So for the remaining days, you should practice, practice, practice. Make sure you give one mock at least. My mock is still going on. 48 hours are still there for the submission. It started at 3 p.m. Indian time today. You still have 48 hours to submit. Give the pre-mock. Okay, so practice as much as you can. Give my mock, give the pre-mock, and then 1.5 day, just revise the concept. That's it. That would be my, I would say, you know, strategy to you. So let's not, yes, pre-populated spreadsheet is going to come for sure. So that's my strategy to you. And as far as your exam is concerned, the December exam, generally it has, you can say liberal marking done. Okay. So generally it has a liberal marking done. So let's not fear it so much. The paper might be difficult, but the marking will be liberal. That's, I can guarantee you. So let's just focus on our practice now, and let's just mute ourselves on the WhatsApp groups. So just focus on what information is being received from formal sources. Okay. Now students are going to confuse you, come up with doubts, and then we'll ask you in DM, please answer this, please do that. No social service at this stage. Okay. You have your TAs for your response. If you're registered with TG professionals, you have your TA for your query support. She will help you. Okay. And the people who are studying, just keep studying, be focused, be calm. Don't create a hype or don't create that nervous situation where you end up messing up things at the end. Take care of your health. The weather is very cold, I believe, some at some places. And yeah, that should be sufficient. So that's it. Okay, question 2 and question 3 of mock 1. So Sean, I've shared the answers of it with you. Question 2 and 3 were quite easy. That's why I've skipped them and spent more time on question 1 and 4. So if you can just read the answer for question 2 and 3, that would be sufficient. Everything is not like, you know, debriefed. And I've said that in the mock debrief as well, that question 2 and 3 is something you can refer from the preset answers. So that's it, guys. And tomorrow we are going to meet for AAA live grand revision. Today it was for the SBR and FR. So thank you guys for being so consistent throughout the session, and the 115 of you who have survived till the end. Congratulations and all the very best for your exam. I really hope and pray that you pass with flying colors. Just be focused, not creating nervous situations, no anxiety, no overthinking. Just work, 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 effort. No fears, no thinking. I would say not even overthinking. Don't think about the outcome right now. Just think about how can I improve my skills and application part of SBR. That's what you have to think right now. And of course, this is going to be a very, very promising session for you. You will realize it later, maybe not now. So after, you give your exam and you remember that, oh, I did a grand revision, and it was the last chord that Tashwita has hit. So this is going to help you a lot. So make sure if you missed any part of it, you do attend it. So that's it. Thank you guys. I hope it was a helpful session, and may God bless you all. See you all maybe with a positive result and maybe in AAA now. So take care, goodbye and good night.